Brian Burke. It's an honor to have you on the show today.
Thank you for having me.
Yes. Thank you for being here. Where are you calling us from?
I'm in Santa Rosa, California.
Awesome. Santa Rosa, California. Is that Northern California or Southern?
Yeah, we're about 50 miles north of the Golden Gate Bridge.
Awesome. Beautiful.
It is.
I haven't been over there yet, but that's, definitely a place I would love to go and check out one day.
Yeah, definitely put it on your list, especially in the summertime. It's nice and warm.
Oh, is it? Yeah.
Oh, yeah.
You can't go over there in the wintertime because even in the summertime, isn't it, doesn't it get kind of cold sometimes?
Yeah, sometimes. September's a really good month. For some reason, fall seems to be the nicest month of the year.
Awesome. So I gotta make sure I put that on a to-do list for sure. On my bucket list, actually. Yeah. So let's start and let's get into your background a little bit, Brian, and tell us how you got started in real estate and kind of take us from there.
Well, I got started in real estate not long after getting out of high school. I was just 20 years old, and I don't know, for some reason I thought real estate was going to be a great business to get into. And, I had no knowledge of real estate. I had no connections in the real estate business. I had no wealthy friends. I didn't have a dime to my name. And I figured since I was fully equipped, obviously, I should just jump right in. So my first investment was just a small house. And, I rented it out, and, it was a pretty bad experience. It was a great way to get jumped into the real estate business by learning all the lessons the hard way. And I did. I learned them all the hard way and decided that I'd had a lot of punishment and I was ready to keep going.
So you enjoyed that hard life, right?
I enjoyed doing things the hard way and learning. That's for sure. I've never done anything the easy way, I don't think.
So tell us about that first deal. Like what was it? And how much you buy it for, and kind of give us a little overview of it.
Oh, you're killing me. You're making me go all the way back to 1989.
That's not too far back, man.
Yeah, it's not too far back. Of course, I remember that. That was about 740 deals ago. But if I recall, it was like somewhere around $85,000. It was a mobile home in Northern California. And I don't remember much about how much it rented for. I ultimately sold it for like $5,000 more than I bought it for or something. I mean, it was a total waste of time, but it was an incredible learning experience. Originally I thought that buying and holding was a great way to, get an entrance into the real estate business, but I quickly figured out that requires capital, and that was one thing I didn't have. So that pushed me towards flipping, and that's what got me into doing flipping. So from that point forward, the next few dozen deals that I did were primarily buy, fix, and resell.
Awesome. So the first one you said it was a mobile home. What did you do right? What did you do wrong on that very first deal? And how old were you at that time?
I was 20, and the one thing I did right is I was able to buy it with no money down. I got a finance company to loan 80% of the purchase price. I got the seller to carry back 20% of the purchase price. So nice. I literally got into it with just closing costs. So that was the thing I did right. The thing I did wrong was pretty much everything else. I rented it to a family member, and that's mixing business and family is not a good idea.
Yeah, that's a big no-no for sure.
It is.
You can't mix that.
Yeah, no, you can't. And, I guess that was probably really the only thing I did wrong. I managed to sell it for more than I bought it for. And considering I put zero money into it, I think that that's ultimately a victory, but it was a very small one at that. So, like I said, not the greatest experience, certainly one I wouldn't want to repeat, but, I ended up being my entrance into this business.
Yeah, sometimes, and especially for a lot of us that start out, the first one is not going to be the best. I mean, it's hardly ever going to be a home run. You're gonna struggle with it, and this is kind of like the same with you. It wasn't necessarily a home run, but hey, it was a learning experience, right? You were able to learn some things and move on to the next one, right?
Exactly. Yeah, that's just it. It was a way to, get your foot in the door, get at least a little bit of experience so that the next house, at least it wasn't the first time I'd ever done this. And it was the seed that planted, an incredible harvest. But boy, at the time, you just don't see it that way. And, people who are trying to figure out how to get started say things like, well, I don't want to start small or whatever. And the reality of it is you just have to start. And even though that really wasn't much of a start for me, it was my start. And if I had done that and I had never started, I wouldn't be doing what I'm doing now.
Yes, I love that, because I think we as humans, we always try to be as perfect as we can, and everything has to be just right for it to go well. Or at least in our minds, it has to be perfect, a picture perfect, and then I can get started. But it doesn't always work out that way, and it's almost hardly. Well, I shouldn't say almost. It's never perfect, And so the key thing, like you just said, is to go ahead and just jump into it and get started, and you'll figure it out. It always works out. One way or another, you're going to figure it out, and so I love that. Yeah.
Yeah, it's true. I like to fly airplanes, and obviously anything that flies, that's what I do when I'm not doing real estate. And
Awesome.
if you think about all the way back to the very first flight, if the Wright brothers had said our first flight is going to be a transcontinental flight, it never would have happened, right? I mean,
No.
when the Wright brothers first flew an airplane, it was measured in feet, how far they flew. And sometimes people want to get into the real estate business and they want their very first deal to be a transcontinental flight, when
Right.
really what they need to be satisfied with is just getting their feet off the ground.
Yeah, exactly. Yeah, that's exactly how we learn. Just take action. Take action, and you'll figure it out. Exactly. So you went from that mobile home, right? And then so what was your next property? How'd you transition? And before we go there, you mentioned that you fly airplanes. So tell us a little bit about that real quick, and how you even did that, or what triggered you to do that?
Well, it was my original career aspiration. So when I was in high school, I got the idea that an airline pilot job was a great idea, and I would get my pilot's license and go to the airlines. So I used the money I earned from bagging groceries. Every week's paycheck was just enough money to pay for a 1-hour flying lesson. And I did that for a year while I was in high school after class and got my private pilot's license. I then learned that it would be about another $30,000 for me to get the training required to get on with an airline. And I'd probably get a job starting at $30,000 a year. And two things didn't make sense. One, I didn't have the money to do it. And second, it didn't seem like a very good investment. So I ended up making a career change into real estate eventually. And the airline thing was a thing of the past, but it was a great it was a great thing to at least get me out there and get the license, give me the motivation to do that.
Yeah, and it's something that you still carry with you. It's a passion, right? It's something that you still carry with you, and you enjoy doing even now. Yeah, that's awesome.
I do.
So yeah, let's dive into that second deal, or into what is it? You went into the single family. Is that correct?
Yeah, single family. So my next deal was the single family flip. It was a house that was in foreclosure that I got a response to sending out postcards to defaulted homeowners, and went down and met with the owner who needed out, had no resources, and literally just needed to get off title. So we negotiated a deal where I would buy the house by giving her $1,500 in walking money. And I would take the property subject to the existing financing, cure the default, which I did by cash advancing my credit cards, and then fix it up, which I did with credit cards, and then fixed it up and resold it and made a whopping $1,500 profit, which was enough for me to buy a new computer. And that was definitely not something that success books are written of.
Right. No, it's not. So how were you able to even think about those creative strategies? I mean, you just mentioned subject to, I mean, were there books written, back then? Well, obviously there's books written all the time, but were there books written specifically on subject to and creative financing?
There were. Yeah, this isn't a new concept. It's been around for a very long time, and there were books on it. There were seminars. There were conferences about like real estate meetings where it was talked about. So between those two purchases, the one I did in '89 and my next one, which was like '92 or '93. I had been doing nothing but studying. I spent 2 or 3 years studying every book, every, newsletter I could get, following all the columnists, just everything I could do to learn about how different strategies in real estate worked. And that's what got me to the position of doing that deal.
Nice. I love that. Talk about the credit cards. Is that something that you recommend to new investors if they don't have another choice? If you come across a great deal, that's a great opportunity, and you don't have another choice. Is that a great first way to get into it, or is there another way that you would think of doing instead?
Absolutely not. I wouldn't recommend it to anyone, but I would, desperate times call for desperate measures, and I had no alternative. I didn't know anybody that I could go to and say, hey, would you invest in this deal? I didn't have any money of my own. I was literally living off the overdraft protection of my checking account. I didn't have anything. So when you're in that position, you just do what you got to do. And to me, that's what I had to do. I wouldn't ever advise anybody that they should repeat my steps, but it worked for me.
It worked for you. So what do you recommend instead of doing that? Do you recommend, maybe finding a partner? Is that what it is? Maybe finding somebody that has the capital and you bring the deal and kind of work on it like that?
Absolutely. It's a lot less risk if you have capital that's, equity capital that's not borrowed. You're not paying, 20% interest on the money. That's just one less hand in your pocket. It's far better to split the profits with someone than service the debt yourself.
Right.
Which is what you're doing with a credit card.
Exactly. Okay. So you bought this property. It was basically, you had a user credit card for it. And so how did it end up?
Yeah, we sold it, fixed it up, resold it, probably owned it for 4 or 5 months. So in terms of that, it was a success. We sold it for a profit, which that was a success.
$1,500?
$1,500. It's just, it's not the type of success you go and write a book about, but it's reality,
Right.
when you're first getting started and, you don't know what you're doing, you don't know how to build in cost efficiencies and all those other things. So, you're out there paying full retail for everything. And, but it was also one of those scenarios where I was literally out there with a trowel digging holes in the front yard to plant flowers. So, it's a great way to really learn how this business is done from the ground up. Now the only tool I know how to use is a pen and a checkbook. But back then, I was forced into a different position.
Yeah, you got to do what you got to do. Yeah, that's pretty right. much. Yeah, exactly. So how long were you doing the flipping? And was this all in California? Was this back in your backyard, basically?
Yeah, it was all in California. I've been doing it ever since. So it's been 25 years or so. We're still doing it to this day to a certain extent. It's just always been a big part of our business.
Okay. And I know your main focus is multifamily. Is that correct?
It is now, yes.
Okay, so why are you still doing single family flips? Is it just to generate some cash to be able to dump it into multifamily, or what is your main reasoning? Is it just a passion of yours, or what do you think it is on that?
Well, I think it's multiple things. I think on one hand, I have the entire infrastructure in place, so why not use it? It would go to waste otherwise. I've got a team that's doing all of it. So it's somewhat on autopilot. I believe in the concept of multiple streams of income.
Yes.
I think that real estate trades in a variety of cycles that all different strategies, locations, and property types are off phase with one another. So, there are times when you just can't make any money, in a buy and hold strategy. There's times when you can't make any money buying office buildings, whatever the case may be. if you have multiple strategies at play and they're off phase with one another, something's always working. And, this gives me one more tool.
Yes, I love that. Don't rely on one source of income and have multiple sources of income, like you just mentioned. That's the way to do it. That's the way to go for sure. So let's shift gears a little bit. You went from flipping houses basically, or you're still currently doing it, but you went from doing that full time to doing what?
Went from flipping houses full time to, well, just basically mostly multifamily is primarily where we're at now. So the way the business evolved essentially was after the real estate collapse of 2007, this small little flipping business that I had that prior to the collapse was, doing a couple dozen houses a year. Just before the collapse, we'd completely scaled back to just very few homes because the market just didn't make any sense at all. But after the collapse, it was like an avalanche of distressed real estate opportunities. So we're faced with this dilemma of, how do we, scale and take advantage of this massive amount of opportunity, which was somewhat like trying to drink from a fire hose.
Right.
So we scaled up and got bigger. We started raising money at a fairly large scale, and grew that little house flipping operation to flipping over 100 homes a year. And we did that for several years. And then at the very bottom of the market, it was really about 2011. Here in California, the market did a double dip, and in the second dip, we started buying to hold and bought a bunch of single families in a rental portfolio with capital we raised from investors, and just knew that flipping and buying and holding were really limited lifespan opportunities in that economic climate, and we needed something that had a longer runway. And multifamily was the way to go. I'd started multifamily in 2003 with a personal investment, and realized that was the business we needed to scale to achieve a real sizable and meaningful business.
Got it. So where was your first property you purchased? Was it there in California, or were you looking at other markets?
My first multifamily property was in California. It was a personal investment on a 1031 exchange. I had bought a couple of foreclosure houses when we were doing flipping many years prior, and they'd gone up in value. So I did a 1031 exchange into a 16-unit apartment building here in California. That was my introduction to multifamily. And then from then I grew to multifamily out of state. I bought an 11-unit building in New York, clear on the other side of the country from where I'm at, which got me an entrance into seeing what it's like to invest in real estate long distance. And then, then from there, when we really started scaling up, our main focus was all in Texas, and we were buying, I started with a 60 unit, and then 136, 140, 276, and then it just grew from there.
Okay. Let's focus on Texas. I'm in Texas now. This is where I live. So let's talk about your first deal in Texas and how that went, and why do you even choose Texas? What was it that you saw in Texas that you didn't see necessarily in other markets or in other states?
Well, what I saw in California, I bought my first property in Texas in 2008. And in California, the real estate market was in total turmoil. It was just complete chaos. So there was no buy and hold opportunity here. So at that point in time. So we were doing a lot of flipping, and I just figured, if I'm going to buy and hold something, I want to buy and hold something where the market doesn't move as much as California, a little bit more upside potential. Somewhere where the values have taken a hit but would climb right back up, and Texas seemed like the logical place to do that. So originally we were looking there for single family homes because the single family homes were just a much better play there than they were here in California, but just didn't find anything, didn't pan out. So it was about a year went by before we finally started looking at multifamily there, and it just seemed like a good market to be in. So the first property I bought there was a 60-unit apartment building in the Dallas market. And just like my very first real estate investment, my very first large multifamily investment was a complete disaster. And it just goes to show you that that's the way this business works. The first time you try something, it's a complete disaster unless you get really lucky. You learn your lessons, and then you figure out how to do it correctly. And that was my college course in multifamily real estate investing.
There you go. So what was it that you learned in this property, in your first multifamily property in Texas?
Well, I learned a lot. I learned I learned that investing in the mid-sized multifamily market, kind of that, 20 to 100 unit space, is a difficult space to be investing in. It's difficult to achieve the scale that you need to manage it effectively. You don't get the economies of scale, and it's not big enough to support a staff, a really good staff. But aside from those lessons, the biggest lessons was how to underwrite properly. You can read all you want in books about how to underwrite an income stream, but until you've actually been through the experience, and and I don't mean being in the experience where everything's going right. I mean, till you've gone through the experience where things aren't going right, you really haven't learned anything yet.
Yes, I love that, because you learn whenever things are not going right. You learn whenever there's mistakes being made, and that's when you actually also grow. But how do you know what to fix if you're not actually doing something wrong? So yeah, it has to be something as unfortunate, but you end up learning from it.
It's true, and it doesn't mean that you're doing anything wrong either. I mean, there's different things that can be at play, and for me, what I did wrong was I got in at the wrong time. I was just about a year too early. Had I waited another year, I would have been fine. The other thing I did wrong was, I just didn't buy the right property. But what really went wrong was the economy. I bought that in early 2008. It was 80% occupied. It needed to be fixed up. So we fixed it up. We did exactly what we needed to do. We got the occupancy to 99%. We did everything right. And then suddenly, now, if you kind of follow the timeline there, we bought it in early 2008. By the time we did all this, it's now late 2008. Which, if you recall back, that's when Bear Stearns collapsed, Lehman Brothers collapsed, banks started failing. Jobs were going out the door faster than you could even throw water over Niagara Falls. And, it was a complete bloodbath economically. The real estate market collapse had already happened. So, that wasn't an impact. It was the economic collapse that came later that was the nemesis of that deal. And that's where the lessons were learned of things don't always go perfectly.
Oh, there's a thing called market cycles. Okay, yeah.
Yes. Yes, and there's a thing called, the tenants lost their jobs and they're not paying, and there's a thing called, economic vacancy, and there's a thing called credit loss, and there's a thing called concessions, and there's a thing called above market vacancy rates, and just all of those things that you start to learn about, and you go, gosh, when I underwrote this deal, I checked out the market pretty carefully, and the average, the average in the market was a 5% vacancy factor. So I assumed that's what I would expect to achieve. And then you realize there's so many other components that aren't reported in that economic or in that physical vacancy factor that impact your bottom line. And you really have to think about those things. So it taught me a lot about how to underwrite real estate properly and changed my entire approach to income property investing. And since that time, we've had a much different experience.
Got it. I love that. So what exactly are you doing to be able to underwrite these properties properly? What do you do? What kind of things do you look for specifically?
There are many things that we do, and I'll start with the one thing that we do not do. The one thing that we do not do is we don't underwrite to perfection. So in other words, what I mean is we're assuming that all kinds of things are going to go wrong. So let's bake that into the financial analysis and just have a plan for that. So instead of assuming that you're going to be 5% vacant because that's what the market's doing, assume that you might be 7% vacant because things might not always go as well. Assume that you're going to have some credit loss from your tenants. Assume that you're going to have to give concessions to fill vacancies when tenants who've lost their jobs move out. Assume that some of your costs are going to be higher than you expected. Bake all that stuff into your financial analysis, and if you can still do the deal, you've probably got a winner. And when things do go right, and maybe life does happen to perfection and you get really lucky, it's a really nice bonus. But if things don't go perfectly, you're not stuck in the situation I was stuck in, where literally on that first property, I was paying the mortgage out of my very own pocket to the tune of $15,000 a month,
Oh,
and did
wow.
it for 3 years because I didn't underwrite it properly. And when you experience something like that once, you never want to experience something like
No,
that again.
definitely not. 15,000. I can't imagine that. I mean, 15,000. I mean, that's a lot of money per month, you said?
Per month. And I did that
Wow.
for about 3 years. It was a very painful experience. At the end of the day, we sold the property. We made a profit. I got all my money back that I loaned to the entity to float the debt.
Nice.
My investors got all their money back and a small profit.
Oh, wow.
But there was no way I was going to let them lose money. I've never had an investor lose money in one of my investments. I wasn't about to start then, and I'm not about to start now. It was one of those back when we were talking about the credit card thing. When you're desperate, you do what's needed to get the job done. And I did what was needed to get the job done. But I don't ever want to do that again.
You do what you got to do. And you mentioned that again. So what do you think happened as a result of that, moving forward with these investors? So what do you think happened? Obviously one of the key things was a trust. They were able to trust you because they saw this guy that they put their trust in at the very beginning. He's putting his own money in this deal, $15,000 a month. I mean, who does that? Most guys would probably let it go. They would just give the keys back to the bank and just say, sorry guys, it's a loss. So what do you think resulted from that moving forward?
Well, first, I think that your assumption is correct. Most of the properties that I saw around us were going into foreclosure, and people were handing the keys back to the bank. So it's true. A lot of real estate operators, when the going gets tough, they disappear. I'm in this for the long haul. So for me, losing my investors' confidence or trust is just simply not an option. That would have been the last deal I would ever have done. So when you think about, okay, I'm going to risk a lot of my own personal money to keep this deal above the line, what do I get in return? Well, I got nothing. I didn't charge any interest on the money I loaned in. It was just a free interest-free loan that I made. But at the end of the day, it bought more loyalty and trust than any other performance metric that I could put on a quarterly report could ever produce. So, what we've gained from that experience, first of all, is knowledge on how to do these things right so you don't get in that position in the first place. Second, we gained an incredible amount of trust from our investors that were in that deal. And third, we talk about that deal all the time to our new investors that have never invested with us before, which may seem somewhat counterintuitive to say, first conversation you have with a new investor that's never done business with you, and you're talking about, this mass chaos. But the reality is it gives people a window or a way to peek behind the curtain, so to speak, and see how we think here. And that builds an incredible amount of loyalty. And, since that deal was over with, we've probably raised $60 million in investor capital. And it's not all because we tell that story, but that story certainly helps to build the trust that's required to raise that level of money.
Yeah, I love that. These investors were able to come back to you because you retained that trust. Definitely wouldn't have happened otherwise if you would have just did a capital call, for instance. So yeah, that's a great story. So what exactly are you doing as far as your underwriting whenever you're for lenders? What do you do there? Are you doing the typical 5-year hold, or what? How do you underwrite that side of it?
We underwrite everything to a 10-year hold, which is a little bit different than what most investment sponsors do. Usually when you hear about a syndicated real estate offering, you're hearing about a 3 or a 5-year play. And, this is what we're going to do. We're going to fix it up. We're going to resell it. You get your money back. this is going to be your return, and it's usually some astronomically high return. We don't underwrite like that. I'm assuming, correctly or incorrectly, that at some point during the hold period of anything that's acquired today, there's going to be an adverse market cycle. Just like what happened to me in 2008 when the economy tanked in late '08. There's now, not to that same extent. I don't forecast at all that it's going to look like the last one looked, but I think there's going to be an adverse market cycle.
It's going to come. It's going to come regardless. Yeah, I mean,
it is.
We're due for it.
We're due for it.
Exactly.
It's going to show up. We don't know when though.
No.
So when I underwrite to a 10-year hold, people have always asked me over the years, are you a buy and hold investor or are you a buy and flip investor? And my answer is a phrase that I coined a long time ago: is I'm actually neither. I'm a buy and watch investor. So what I'm doing is I'm buying the real estate and then I'm watching the market for the optimal point of exit. Now, while we're doing that, if an adverse economic cycle or an adverse real estate cycle is looming in the midst and throwing our plans askew, we can wait it out. So if I underwrite everything to a 10-year hold, we can wait out a market cycle and we can sell at the other market cycle peak on the other side. So really our plan behind the scenes is we buy the property, we fix it up, we sell it in 3 years if we can, we sell it in 5 years if that's what it takes, and we sell it in 10 years if we have to. But we've underwritten it all three ways so that we know what each of those three scenarios looks like in the, not a perfect world, but in a reasonable world, the way we underwrite. And if a deal passes all three of those tests, it's a go. But that 10-year horizon is very important to us because that's your downside scenario.
Got it. So obviously the bank, the lender, you're underwriting to a 10-year hold as well. So do you ever go into a deal and then do a refi into a longer term debt, or is it always shorter like that?
So right now, our favored debt instrument has been a 7-year floating rate loan. And so most of the deals we're buying right now are priced somewhere between $10 and $30 million. So, you're talking about loan sizes, call it, $7.5 million to, 20 something million dollars. Now in that space, debt that comes with a fixed interest rate comes at a price, and that price is called yield maintenance, which in essence is a very, very punitive prepayment penalty. Now, given our strategy of one where we want to watch the market and exit at the optimal point, I don't want a yield maintenance penalty to be the key driving influence behind that decision. I want the market, and I want performance, and I want IRR to be the key the key yardsticks to when we make that exit decision, not worrying about a $2 million prepayment penalty. So with a 7-year agency floater, we can sell anytime we want after the first 12 months, and that's our favored debt instrument. To get to the 10 years, our plan is always that once we've fixed up the property, brought up the income, done our value add scenario, if we don't sell at year 3, our plan would be to refinance at year 3 with a larger loan amount so we can return some capital to the investors, therefore increasing their internal rate of return. And that gives us another 7 years, and that gets us all the way to our 10.
Got it. I love that. So going into a property, what is the target IRR that you look for? And first of all, for those of the guys out there that don't know exactly what IRR is or what it stands for, can you explain that a little bit?
Yeah, the IRR is the internal rate of return, and it's basically the rate of return that would be required to bring the present value of all future cash flows to zero. So basically, if you think about it, the simplest way to think about IRR is it it encompasses your cash on cash return, your periodic return that you get throughout the hold period, as well as the cash flow that you receive from refinances and the exit. And it also accounts for the timing of those cash flows. So to me, it's the most consistent way to measure one investment versus another investment. So we use internal rate of return heavily in evaluating the investments that we do here. Now, when you say, what IRR do you target? Well, that's when the question starts to get more difficult, because every deal has a variety of internal rate of returns. And different people look at those different rates and place more emphasis on one versus the other. So, there's an IRR unlevered. That means if there were no debt on the property, what would the IRR be? Well, that allows you to compare one investment versus another with no regard to what debt is available or what debt you use. That's fine. That's one way to measure one piece of real estate against another piece of real estate. But it's not very relevant to the performance of the investor. The other method is levered IRR. Now, this is the IRR that the deal itself throws off without accounting for there being an investment sponsor that's taking any splits or fees, but it does factor in the debt service, and the leverage that you get from the debt, and the any cash out that you receive from refinances along the way. And then finally, there's the net IRR to the investor. And this is what the investor actually receives. If you look at the investor's bank account and you look at the cash that went out and the cash that came back, that would be the investor's net IRR. So, we look at all three of those yardsticks, and there's some that are more important than others in certain scenarios. But for us, primarily what we're looking to achieve is we want to be able to deliver an IRR of 14% or greater to our investors net, after all splits, fees, financing costs, everything. So net into our investors' pocket of at least 14% over a 10-year hold. And we'd like to see that number be larger in a 5-year hold, and we'd like to see it be larger still in a 3-year hold. So typically, if you're looking at 14s on a 10-year, you're looking at 15 maybe on a 5-year, maybe 16 and a half on a 3-year, that type of thing.
Awesome. Great information. That clarified a lot for myself and for a lot of guys out there. That's great. Awesome information. So let's shift a little bit and talk about what is your way of managing these properties? Are you do you have your own management company or is it a third party property management source?
When I started out, I did all third-party property management, and we still use third-party management in some of our assets that we've owned for a while, where we've already had that third-party management in place. But last year, took the leap of forming our own management company. We've finally gotten large enough to do that. I found the team that was perfect for it. And I brought some more guys on board. We created our own in-house management company, so now we're vertically integrated, and now we are able to do that in-house.
And so, talk about the benefits on that. Obviously, it's your own company, so you're able to. You just said integrate your own systems. It just makes it for much smoother transactions and process, doesn't it?
It does. There's a lot of advantages to us. One is just simply on the accounting side. Now we've integrated, all of the accounting with our own systems. We've created an incredible infrastructure that allows us to be able to, look at all kinds of analytics that we didn't have the ability to do, or at least not as easily when we weren't doing all the stuff in-house. We have a little bit more control because these teams are in our own office. So we have that. But the big advantage is that it does two things for us. One is it expands our team. So it tells a different story. Now when we're talking to investors, we've got a team here that has 90,000 units of multifamily experience. that's operated in probably 40 out of the 50 states. And so that helps us not only in talking to investors, but it helps us in talking to sellers when they're trying to pick, I've got 15 offers on my property. Who's the right buyer? Hey, these Praxis guys, they got 90,000 units of multifamily experience. They've owned thousands of units in this market before. They look like a good choice versus the guy that, this is his first deal. So, that's another way that it really helps. And finally, as we've grown and scaled, we're now partnering, or at least looking to partner with institutional capital partners that, will write us checks for $10 million or more for our deals. And most of those groups that are willing to write checks like that want to see that you have your own vertically integrated management and aren't relying on third-party management companies.
Great. So this is all possible. I think it's all possible for anyone looking to scale up and grow, but it doesn't happen overnight. How long have you been doing this? You've been doing it for quite a while now, but in the process, you built so much experience, so much of a track record that you can take that never goes away. It's always in your back pocket, and I think that's as crucial to be able to implement your and grow, implement your systems and keep growing and growing, and at the scale that you're doing it. So, which leads me to my next question: how important is it to have a great team around you? I know it's one of those questions like, well, yeah, obviously it's important, but I want you to kind of maybe dig a little deeper and tell us why it's so important and why it's so critical, especially in the multifamily space. It's hard for you to do it alone.
Well, for several reasons. I mean, one is that as you scale, this becomes a big business. And to effectively operate a big business, you need big resources. And you can't do it all by yourself. So you either need to hire an incredible staff, or you need to have really good partners that bring experience and or something to the table that you don't bring. And that was important. For example, I was buying almost entirely in Texas and California. I had one deal in New York. I bought one in Arizona. But, we scaled up into Georgia and Florida last year in almost entirely because the team that I brought on had experience in those markets, and that added human resource enabled us to, break geographical boundaries and grow into new markets. And, I just couldn't have done that by myself, at least not as effectively. So that's really important. The other thing that's important as it relates to team is that, investors want to see a solid team. They don't necessarily want to invest in a one-man band. They're putting a lot of their hard-earned money up into a deal for a number of years, and key person risk is real to them, where they're like, you used to always get the question, what happens if you die? Well, when you're first starting out, and if you're a solo operator, the answer to what happens if you die is usually like, geez, hopefully they can clean this up and you can get your money back. Yeah. Now if somebody asks that question, it's like they'll hold a funeral. Nobody's going to miss me. So, it mitigates that key man risk or key person risk that is seen in a small shop. And I think it's important to investors to see that in an organization.
Right. And what is that quote? What does it go? It goes like, teamwork makes the dream work, or something like that. Yeah, it's so important. You have to have the right team. Otherwise it's going to be pretty difficult for you to keep growing, and especially at a scale like you're doing it. That's great. So let's switch gears here a little bit, and let's get into our nuggets of wealth. All right, you ready for these?
I'm ready.
All right. So what is one key tip that you could give to those multifamily investors who are looking to scale up to a bigger level, such as yourself?
Underwrite conservatively is the big one. Don't let emotion drive your decision. I understand the feeling that you get when you look at a large multifamily deal when all you've done before is small deals. and there's this, I got to do this, I got to get this deal, I got to make this happen type of a mindset. And you just can't let that cloud your decision making. Take a step back, evaluate the deal, and make sure it's the right one and that you're approaching it correctly and underwriting it correctly, because you don't want that exciting experience, that first deal, to be your last experience, nor do you want it to turn into that pit in your stomach feeling that you get when things are going to hell in a handbasket and now you got to figure out how to salvage the thing. Because I've been there.
Yes, you have. And I love that. That's great advice. Guys, listen up on here. So what did you have to sacrifice to get to where you are today? And how do you stay committed?
Well, I had to sacrifice a lot of time. In the very beginning, this doesn't make you money. So, I was working full time and then doing real estate. And it's like every minute of every day was consumed with either earning a living or building a business. And it's an incredible sacrifice and a difficult sacrifice, but it doesn't just happen. You don't snap your fingers and everything falls into place. So you just have to be ready for that. And what keeps me going is that I don't have a choice. What else would I do? First, I love what I do. And second, I don't want to do anything else. I think about, like if you die and get reincarnated, what would I want to come back as? Well, maybe I'd want to be a shark or a cat or something like that,
Right.
Or I could either, I can eat everything in the ocean or just sleep all day or, be at the top of the food chain. But I wouldn't want to come back and, and do anything other than what I'm doing right now. So that keeps me motivated, because if I stop doing this, then what?
Exactly. You got to have a passion for it, basically. The passion is what kind of keeps you going. It pushes you, regardless if you feel like doing it or not. You're going to do it. If you have a passion for something, you're not working. You're doing it because you love doing it, right?
That's right.
Yeah, I love that. What is one key tool, source, or platform that you frequently use that can also help others?
Good question. I think that one of the key tools for me is data. Just researching where I want to invest. I talked earlier about market cycles and how they cycle out of phase with one another. So what I mean by that is flipping houses in California might work great, and multifamily in Dallas, Texas might work great, but the opposite might not be true. So knowing what strategy works, where it's working, and finding the data to support that thesis is an incredible tool. So market research, economic research, these are all very, very important to our business. Some of the key tools that I use is the Milken Institute's Best Performing Cities Index, which is an annual report, comes out every December or January and shows the top performing cities in the country. I use the ULI, the Urban Land Institute, puts out a lot of really good data. They have a report that comes out every year that talks about trends in multifamily. I like REIS, which is a data service that gives rent growth forecasts. It's a paid service and it's not cheap, but it's really good. It has competitors like Axiometrics and CoStar, which are good as well. But just reading the news and researching the economic fundamentals of markets is the key tool to success in this business.
I love that. And those are things that people tend to overlook. Just research and data. Those are things that people, they most of the time they look at the property, they look at the structure, they look at the numbers. Okay, it works. But what about
you look at deals? You look at deals. That's what people do. They look at deals.
Exactly.
So here's the analogy, right? The deal is your raft. Okay, so if all you're doing is you're focusing on your raft, you're probably going to get a pretty darn good raft. But if you throw it in the river and you're trying to go east and the current is going west, you're going to work really, really hard to go absolutely nowhere. So the research part is knowing what direction the current is moving in the river to determine whether or not it's flowing in the direction that's going to take you to where you're trying to get to. So it's more important to research the river than the raft, because you'll go further clinging to a log going downstream than you will paddling your life away trying to go upstream on your really nice raft.
Wow, I love that analogy. That's awesome. Yeah, you guys, that's going to be easy to remember there. So yeah, I love that. Okay, what do you envision for your business long-term future?
Long term, we're headed to 10,000 units. We've crossed the 1,500 mark or thereabouts. We're building fairly rapidly. We're aiming for 10,000 units. We might get to 15, and who knows, maybe we get to 20,000. I'll be doing this, well, probably till the day I die, but at least for another 20 years, I would think. And during that period, I think we'll scale up, we'll maintain that scale, and then we'll wind it up.
Awesome, I love that. Last question for you, Brian. In just a few short words, at the end of your life, how do you want to be remembered? How do you want people to remember you?
Well, gosh, if they remember me, I'll be surprised. But I suppose if they think of anything, they'll remember me as someone that treated everybody fairly, tried to give back whenever I could, did right by my investors, and helped build wealth and make money for all of my clients. If I can be remembered by having done all of those things, I'd score that in the win column.
Great. That's an awesome answer. Well, Brian, it was a great honor to have you on the show. I really appreciate it. I love the value, tons of value that you provided. And I appreciate that. And I wish you continued success.
Well, it was a pleasure to be here. I really appreciate the invite. Thanks for having me on.
Thank you very much.
You got it.